These are a few stocks that are looking interesting right now. So for reference, this is my portfolio. I update this weekly on the channel, of course. So feel free to check it out. So in today's video, I'll be covering a few stocks that are looking like decent buys right now. And the first stock that I'll be covering is S&P Global, of course. I know I sound like a broken record talking about this one. But the thesis is extremely simple. It's just your interest rates coming down, your macroeconomic conditions improving, S&P Global having the debt wall in 2028, and the mobility spin-off as well. So for S&P Global, if you were to look at the guidance from the management, they're projecting between 5.6 and 5.8 billion of free cash flow. So the end of year price to free cash flow for S&P Global will be at around a 25 times. So besides that, they are also projecting around 85% of the free cash flow being returned to shareholders. That is what they do almost every single year. So when you add those things up, assuming that S&P Global can maintain its multiple of around 25 times price to free cash flow, then your real returns from this stock is simply just the growth in terms of the free cash flow per share. So free cash flow per share has been growing historically at between 15 and 20%. While I don't think that is possible for S&P Global in the future, it should probably be able to grow at around 12% every single year. So S&P Global currently, the price to free cash flow metric is at around a 26.7 times. So on a forward basis, it's at a 25 times end of this year. So for S&P Global, besides the normal theses that we have always been talking about, there's another possible catalyst for this company, which is the mobility business being spun off. So what the management has done over here is they're trying to concentrate the business into its key financial streams. So they want it to be concentrated in market intelligence. You want it to be concentrated in your ratings portion, which will allow the markets to re-rate the stock again, maybe give the credit rating as well as the financials portion an even higher valuation as compared to what it is today. So the next stock is FICO. So FICO has almost entirely erased its 20% up move in one single day after its new pricing model. So the stock is currently trading at $1,600 a share. So for FICO, there are two main theses for the company. First of all, it's just your mortgage sector recovering. So with your rates coming down, you will see increased usage of credit, which will not only boost up their mortgage portion, but also their autos portion, as well as their normal consumer credit portion. Besides that, this is what the sell-side report actually said about FICO's new direct pricing model. So they say over here that FICO's new direct pricing model will contribute at least 20 to 25% adjusted EPS growth in 2026. So that is without the other segments growing as well. So what they're saying over here is that they expect the mortgage portion to double in terms of pricing next year, which will lead to a 20 to 25% increase in terms of EPS next year. So if you were to account for the other portions as well, the consumer and the autos portion have grown at around 15%. So if we were to bake that into our assumptions, this will be the number here. So we would expect around a 45% increase in Score's revenue, by the way this is in the Substack, and a 30% contribution to the EPS. So this is without the software portion. So if you were to account for the software as well, we could go to around 40% increase in EPS just next year. So the stock now trading at a 62 or 63 times of earnings is still expensive, of course, but it isn't as expensive as what the growth says, and this is not accounting for the mortgage recovery as well as increased credit usage as well. Next stock that I'll be covering is Mercado Libre. This is a stock that I've been reading up on quite recently. So the stock is down around 17% in the past month. And so for Mercado Libre, they have two main business lines under them. So they have the Mercado Libre, which is their marketplace. Similar to Amazon, they have many different business lines under this portion. They have the marketplace, they have logistics, they have advertising. So currently now the marketplace is the dominant one in this entire portion under the commerce segment. So currently now marketplace is still the majority of their revenue as well as their net income under this Mercado Libre portion. Advertising is very, very small. It's around 2 to 3% of their GMV. Logistics is not really profitable. What the company is trying to do with their logistic network is to increase the value-added services for its consumers to try and increase the customer loyalty in this segment. So it's not really profitable yet, but it will be in the future, similar to Amazon. So Mercado Libre's commerce portion is basically a replica of Amazon, but in Latin America. The business lines are similar, the competitive advantages are also similar. It is in their logistical networks, it's in their network effects, and so on. Basically, both a flywheel effect as well as a physical asset moat. So they have already built out all these fulfillment centers and all these distribution centers, and it's hard for a new competitor to come in and spend that much money to try and build out all this infrastructure. The other portion of the business is the Mercado Pago portion. Basically, this portion is the credit portion for Mercado Libre, makes up around 40% of their entire revenue. So under this portion, they have the digital wallets, they have the credit portion where they give out credit to consumers, merchants, and so on. And they also issue credit cards as well, and buy now, pay later as well. And then they acquire merchants on this side. So they provide QR codes, they provide POS systems in Latin America. So this portion is actually the one that is providing a flywheel effect for Mercado Libre. It creates a system where consumers who buy on their platform will just directly use their own digital wallet. It's similar to what Shopee is doing in Southeast Asia. They're trying to extend their wallets, trying to extend that credit portion by introducing all these different products. So Mercado Libre is doing something similar in Latin America as well. Shopee is doing something similar there, but on a much lesser scale. So under this portion, a main key risk tied to it would be consumer credit, because in Latin America, a lot of the consumer credit is actually low quality. So what it means is it leads to a lot of delinquencies, it leads to a lot of non-performing loans, which is a worry for Mercado Libre's credit portion. While I don't think this is the best business line because it is leveraged to an extent, this portion is actually important for Mercado Libre. It creates an entire ecosystem, something that Amazon doesn't have, something that Shopee is actively doing as well, something that Alibaba has, which has been done in China already. For Mercado Libre, here are some key metrics to look out for. First of all is your GMV growth. Of course, your GMV growth in Latin America is still very, very strong. It's around 20% for all these different countries here. And the other key metric to look out for is this metric here, which is NIMAL, which is your net interest margin after losses. So NIMAL is basically the interest that they charge their consumers and the people that borrow money from Mercado Libre, minus the cost of credit from Mercado Libre as well as the losses. And usually you want the NIMAL to be trending upwards in order for it to be positive for Mercado Libre. But there are some reasons for this going down. Mercado Libre is actively going up market. So what that means is they're trying to target people with higher reliability, with lower risk of default. So that is why this NIMAL portion is actually declining. They're charging lower interest rates for people that are more reliable, that are more able to pay back the money loan from this credit line. So for Mercado Libre as well as the other companies in Latin America, the main thesis would simply be just an increase in terms of your GMV in all these different countries. Because in Latin America, the internet penetration is still relatively low. So for example, in the US, most people use the internet already. But in Latin America, it's around 70% only. Besides that, in Latin America, your retail penetration is only around 11%, which is relatively low compared to the US as well as in China. So we can expect strong growth in this segment over the next 10 years, 20 years, as Latin America modernizes. So I know some people would say that Mercado Libre's thesis is too simplified. The market already knows this, the market is already pricing it in. But the counter argument to this would be that your Max 7 companies are already well covered. Most analysts know about your Max 7 companies, and yet every single year your Max 7 companies keep going up. Why? Because the fundamentals are improving. When fundamentals improves, then naturally your stock price will go up as well. This company is an extremely simple story, which is the growth in Latin America. So for Mercado Libre, this is a company that I've been tracking. I'll be doing a deep dive soon if I think the company is worthy to cover. And for Mercado Libre as well, this is a metric that I'm using for the company, which is your price to gross profit. So why am I using price to gross profit? So let's talk about some of the metrics that people commonly use. So price to sales is normally used for non-profitable companies experiencing high growth. Mercado Libre is already profitable. P/E ratio is normally used for your mature or cash flow generative companies, same for price to free cash flow. Your EV to EBITDA is similar to your P/E ratio, just that it removes the reliance on debt. It is also for more reliable and mature companies. Whereas for companies that reinvest heavily into the business, like for example Amazon back in the day, like for example Mercado Libre right now, it is inappropriate to use price to earnings because the company is artificially suppressing its earnings ability by reinvesting continually into the business. So that's why price to gross profit is probably the suitable metric for the company. And based on this metric here, the company is actually trading at a decent valuation today. So at today's price, you're paying a price to gross profit of around 9 times. So on a historical level, this is still relatively low. That's why I think Mercado Libre today, despite the 50p ratio, seem cheap on this metric here. Next portion, I'll be covering some of the earnings this week. So on Tuesday, we have Netflix reporting earnings. This will be the massive one on Tuesday. And then on Wednesday, we have another Mac 7 company reporting earnings, which is Tesla. So let's talk about Netflix first. The company is currently trading at a 51 times of earnings, at a 41 times of forward earnings. And year to date, I believe it's up around 30%. So for Netflix, the story for the company is simple: price hikes and increasing operating leverage. So the company already has a pool of all the different films that they have, and they already have systems built out for all these different filmmaking portions. So I don't expect the cost to continually go up. On the other hand, their earnings will probably keep going up with their increase in pricing, their increase in volumes, and so on. So for Netflix, it's still a relatively positive company. And apart from the high valuation, I think this company is a quality business for you to look at. So Tesla is currently trading at a 261 times price to earnings and a 222 times forward earnings. So based on this metrics here, the company is extremely expensive. It is in a bubble, probably. And this company here is a company that is actually decreasing in terms of its fundamental quality. So this is the company's gross profit by segment. And I know a lot of people will say that, oh, Tesla is an AI company, Tesla is an energy company. But if you're to look at the gross profit by segments, most of it is still made up by this auto segment. So that argument there is a bit flawed. And for this company, it is a company that is weakening in terms of fundamentals. A lot of the profits that they realized a few quarters ago was actually tied to crypto. So for this company here, it's a company that is detached from its fundamental stock price. I would avoid this one at all costs, although I think Elon Musk is an amazing businessman. I hope you guys have found this one useful and invest safe.